Beating the Street by Peter Lynch. Picture this, a classroom of fidgety 7th graders in Arlington, Massachusetts. It's social studies, and honestly, nobody's really paying attention. Their teacher, Joan Morrissey, decides to shake things up with an experiment that would change everything. She splits the class into teams and hands each one a pretend portfolio worth $250,000. The challenge? Invest it. Pick stocks. See who can make the most money over 2 years. Sounds like a harmless school project, right? Maybe a fun way to learn about money. But what happened next was absolutely wild. While the smartest, highest-paid money managers on Wall Street were barely treading water, these kids were absolutely crushing it. No fancy computers. No Ivy League degrees. They couldn't even drive yet. But they had something Wall Street didn't. They invested in what they knew. Their friends were obsessed with clothes from the Gap. They bought Gap stock. They were trading Topps baseball cards at recess. They bought Topps. They drank Pepsi, ate at Pizza Hut, and knew that Nike sneakers were basically social currency. So they invested in those companies too. They had one beautiful rule: never invest in anything you can't draw with a crayon. Over 2 years, these 7th graders' portfolio shot up almost 70%. The S&P 500, the gold standard for measuring the market, up just 26%. These kids didn't just beat the market, they demolished it. They outperformed 99% of professional fund managers in the entire country. This story, which became known as the Miracle of St. Agnes, is the perfect way to kick off our journey today. We're diving into Beating the Street by legendary investor Peter Lynch. For 13 years, from 1977 to 1990, Lynch ran the Fidelity Magellan Fund, growing it from a tiny $18 million to a massive $14 billion powerhouse. If you'd invested just $1,000 with him at the start, you'd have walked away with $28,000. The guy was an absolute legend. But here's the thing. His message is shockingly simple. It's the same lesson those St. Agnes kids stumbled onto. The secret to successful investing isn't buried in complicated formulas or Wall Street speak. It's literally all around you. It's in your shopping mall. It's in your fridge. It's in your driveway. Today, I'm walking you through Peter Lynch's philosophy. And by the end, you'll understand something powerful that Wall Street really hopes you never figure out. Your biggest advantage as an investor isn't some fancy degree or supercomputer. It's you. It's what you already know. Learning to trust that? That's how you beat the street. So where do we even start? Investing can feel overwhelming. Recessions, inflation, bull markets, bear markets, enough to make you want to stuff cash under your mattress and call it a day. Lynch gets this. He tackles the most basic question first. Why should you even bother with stocks? He calls this chapter Escape from Bondage. For generations, we've been told the safest place for our money is bonds, certificates of deposit, or plain old savings accounts. You get guaranteed interest. It feels safe, responsible, adult. But Lynch pulls back the curtain on a harsh truth. Over time, safe investments are often the riskiest choice you can make. Why? Inflation. It's the silent thief that makes your money worth less every year. That dollar today won't buy nearly as much in 10 years. The interest from your bond might feel nice, but if it's not beating inflation by a solid margin, you're actually getting poorer, just in slow motion. Stocks are different. When you buy a stock, you're not just lending money to a company like you do with a bond. You're buying a piece of the business itself. You're becoming an owner. As that company grows and becomes more profitable, your piece of the pie grows too. Lynch points to decades of data showing that stocks have consistently delivered returns double or even triple what bonds provide. He mentions a study spanning from the 1920s to the 1990s. In over 60 years, bonds only beat stocks in one decade, the 1930s during the Great Depression. Every other decade, stocks won handily. He famously wrote, "Gentlemen who prefer bonds don't know what they're missing." So lesson number 1 is a mindset shift. If you want more money tomorrow than you have today, you need to put a meaningful chunk into stocks. Period. The real risk isn't market dips. It's the slow, guaranteed erosion of your money's buying power. But wait. What about when the market crashes? What about the fear? This is where Lynch drops one of his most powerful insights. The key to making money in stocks is simply not getting scared out of them. Success isn't about brain power, it's about having the stomach for it. He tells this hilarious story about the Barron's Round Table. Every January, this financial magazine would gather the world's top investment experts, including Lynch, to predict what the economy and markets would do that year. These were the absolute best minds in the business, managing billions. And year after year, they were almost always wrong. In 1987, the year of the most famous market crash in recent history, they were nearly all wildly optimistic. The one cautious voice? Pretty much ignored. Then after the crash, when the market was full of incredible bargains, they were doom and gloom, predicting another Great Depression that never happened. Lynch's point hits hard. If the smartest people in the world can't predict the future, what makes you think you can? He calls it weekend worrying, reading scary headlines on Saturday morning, and getting so spooked you want to sell everything Monday. He reminds us that market declines are as routine as Minnesota snowstorms. They happen. They're normal. Over 70 years, the market has had 40 scary drops of 10% or more. If you sold out every time you panicked, you'd have missed all the incredible gains that followed. The winners aren't the ones trying to time the market perfectly. They're the ones who understand they own pieces of great companies, and over time, those companies will grow, regardless of temporary panic. A market crash isn't a disaster, it's a sale. Your favorite companies just went on discount. This brings us back to those 7th graders. Their success wasn't luck. It was the result of Peter Lynch's core philosophy: invest in what you know. He argues that regular people encounter dozens of interesting companies just by living their lives. The advantage isn't on Wall Street. It's at the mall, the supermarket, your workplace. He calls it, quote, local knowledge. He tells the story of his wife Carolyn coming home raving about this new product called Legs pantyhose. They came in clever egg-shaped containers and were sold in supermarkets, somewhere no one had sold pantyhose before. She loved them. All her friends loved them. Lynch did a little digging, found the company behind them, Hanes, and bought the stock. It went up 6 times. Same thing with Taco Bell. He lived in Boston, tried their food on a California trip, and was blown away. He saw how popular they were out west, and realized 90% of the country had never heard of them. He knew they had huge growth potential. The stock became what he called a 10-bagger. It went up 10 times. This is the amateur's edge. Some professional fund manager in New York might never notice a hot new restaurant chain in Texas or a packed clothing store in Ohio. They're too busy staring at screens and listening to other Wall Street types. But you're there on the ground. You can see it with your own eyes. Feel the buzz. See the checkout lines. Talk to employees. Lynch did this constantly. He famously preferred spending time at the mall over his office. He'd take his daughters shopping not just to buy stuff, but for research. They led him to the Gap, which became one of the best-performing stocks of the decade. They introduced him to a new drink called Clearly Canadian, which he regrettably missed, as it became a 9-bagger in 1 year. His message is simple: pay attention to your own life. The doctor who sees a game-changing medical device in the operating room has an edge. The mechanic who notices one brand of parts is way more reliable has an edge. The teenager who sees everyone at school suddenly wearing the same sneakers has an edge. But here's the crucial part. Just liking a product isn't enough. That's only step 1. Liking the store is a good sign, but you have to do the homework. Stock picking is part art, part science, and a whole lot of legwork. So what does this homework look like? For Lynch, it meant understanding the company's story. Every stock has a story, the simple, plain English explanation of what the company does and why you think it'll succeed. If you can't explain why you own a stock to a fifth grader in under 2 minutes, you shouldn't own it. To understand the story, he'd read the company's annual report. Not for complicated numbers, but for the story. He'd checked the balance sheet to answer 2 questions. Does this company have lots of debt? Does it have cash? A company with a strong balance sheet, more cash than debt, can survive a recession. A company drowning in debt is fragile. Then he'd categorize the company. He believed stocks fall into a few simple categories, and knowing which one tells you what to expect. First, there are slow growers. Big, aging companies, like utilities. They won't grow fast, but they often pay steady dividends. They're like old, reliable oak trees. Then you have stalwarts. Big, familiar giants, like Coca-Cola or Procter & Gamble. They won't give you a 10-fold return overnight, but they provide consistent, moderate growth. A 30% gain is a big win. Lynch saw them as protection. In a recession, people might stop buying cars, but they'll still buy toothpaste and soda. Next are fast growers. These are the exciting ones. Small, aggressive companies growing at 20 to 25% a year. This is where you find the 10-baggers, 20-baggers, even 100-baggers. A restaurant chain with a few locations about to go nationwide would be a fast grower. The Body Shop was one. Higher risk, but huge potential reward. Then there are cyclicals, companies whose fortunes rise and fall with the economy. Car companies, airlines, steel companies. When the economy's booming, they do great. When recession hits, they get hammered. Lynch says timing is everything with cyclicals. You have to recognize when the cycle's turning and get out before it's too late. And finally, his 2 favorite categories, turnarounds and asset plays. A turnaround is a company that's been beaten down and left for dead by Wall Street. Maybe it's near bankruptcy, everyone's given up. But if it can solve its problems and stage a comeback, the stock can soar. His most famous turnaround was Chrysler. In the early 80s, everyone thought Chrysler was toast. The stock had crashed to just $2 a share. But Lynch did his homework. He looked at their balance sheet and saw over $1 billion in cash. They weren't going bankrupt anytime soon. He visited the company, met legendary CEO Lee Iacocca, and saw the new cars they were developing, including something revolutionary called the T115, the world's first minivan. Lynch realized Chrysler was on the edge of a historic comeback. He bought as much stock as he could, making it his #1 holding. His friends thought he was crazy, but as the minivan became a massive hit and the auto industry recovered, Chrysler's stock went from $2 to what would be equivalent to nearly $100. A 50-bagger, it made billions for his fund. Classic turnaround. Then there are asset plays, companies sitting on something valuable that the market has completely overlooked. Could be real estate, a patent, a pile of cash, even a tax break. Volvo was an asset play. Lynch discovered the company had so much cash that the cash per share equaled the stock price. Basically, if you bought the stock, you got the entire car business, factories, brand name, everything for free. By putting companies into these categories, Lynch knew what story to look for. With a fast grower, he wanted to see room to grow. With a cyclical, he wanted to see if the industry was turning up. With a turnaround, he wanted to see if the company had a survival plan. He also had principles, little rules of thumb guiding his decisions. One was, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Quality matters. Another, never fall in love with a stock. Stay objective. Your loyalty is to the story, and if it changes for the worse, you have to be willing to sell. He called the opposite habit, pulling out the flowers and watering the weeds, selling winners too early while holding losers, hoping they'll bounce back. He believed in diversification, but not how most people think. He didn't just buy 100 different stocks to spread risk. He often owned hundreds, even thousands of stocks in the Magellan Fund. His philosophy was more like prospecting for gold. He said searching for companies is like looking for grubs under rocks. If you turn over 10 rocks, you'll likely find 1 grub. If you turn over 20, you'll find 2. His smaller positions were like turning over rocks. He'd buy a small amount just to keep track, get on their mailing list, follow the story. If the story kept getting better, he'd buy more, and that small position could become one of his biggest winners. This leads to a fascinating part of his journey, managing a fund that became massive. Critics constantly said Magellan was too big to succeed. How could a $10 billion fund possibly be nimble enough to beat the market? Lynch proved them wrong year after year. His method was counterintuitive. As the fund grew, he actually focused more on smaller companies. A huge fund can't just buy 1 million shares of IBM and call it a day. To get an edge, you have to find undiscovered gems. He'd buy dozens, even hundreds of small, promising companies, regional banks, local retailers, niche manufacturers. One alone wouldn't matter to a multi-billion-dollar fund. But 100 of them, all growing together, absolutely could. He also started investing internationally. He was one of the first major American fund managers to see incredible opportunities in foreign stocks. He'd travel to Europe and Japan, visiting companies no American analyst had bothered with. He found incredible bargains, companies like Volvo or Skandia, a Swedish insurance company so undervalued it was like they were giving shares away. His willingness to look where others weren't gave him a massive advantage. Through all this, his core philosophy stayed the same. Whether the company was in Ohio or Sweden, whether it made cars or ran funeral homes, he was always looking for a good story, a growth story, a turnaround story, a hidden value story. Near the end of the book, he summarizes his life's work into 25 golden rules. Simple, powerful, worth remembering. Things like, know what you own and know why you own it. Never invest in any company before you've done the homework on its earnings prospects, financial condition, competitive position, and expansion plans. Long shots almost never pay off. There's always something to worry about. Avoid weekend thinking and ignore scary headlines. And perhaps most importantly, everyone has the brain power to make money in stocks. Not everyone has the stomach. After 13 years of relentless work, visiting hundreds of companies yearly, reading thousands of annual reports, managing a fund the size of a small country's economy, Peter Lynch decided to retire. He was only 46. He famously said he wanted to spend more time with his family than with Fannie Mae, one of his biggest holdings. He remembered his father had passed away at 46, and it made him realize there was more to life than the office. As he put it, nobody on his deathbed ever said, "I wish I had spent more time at the office." But even in retirement, his message has never faded. It's a message of empowerment. You don't need to be a Wall Street genius to succeed. You just need to use the knowledge you already have. Do a little homework. Have the courage to stick with it through ups and downs. And trust your common sense. The same common sense that tells you a crowded store is probably a good business. The same common sense a group of 7th graders used to beat the best in the world. When you step back and look at Peter Lynch's ideas, what's striking is how simple and timeless they are. In a world obsessed with complexity, algorithms, cryptocurrency, meme stocks flying up and down for no reason, Lynch's philosophy feels like fresh air. It brings investing back down to earth. The most powerful lesson in beating the street isn't a stock-picking formula. It's a fundamental shift in how you see the world. Investing isn't a game played by experts in secret code. It's the business of owning businesses. And the best way to understand a business is to be its customer, its employee, or just an observant neighbor. This is more than financial strategy. It's a lesson in paying attention. It encourages curiosity about the world around you. Next time you're in a crowded restaurant or fall in love with a new product, Lynch's voice will whisper in your head, "Is this a public company? What's the story here?" It turns everyday life into a field of opportunity. The second profound lesson is about temperament. Lynch is adamant that the stock market transfers money from the impatient to the patient. Your biggest enemy isn't a bad company. It's your own fear and greed. His stories about the Barron's Roundtable and constant media doom predictions are powerful reminders to tune out the noise. The world is always full of problems, but humanity is also full of problem solvers. Companies keep innovating, People keep working, and the economy, over the long arc of history, keeps growing. Having faith in that bigger picture is the bedrock of long-term success. So how can you put these ideas into practice right now? Here are 2 simple things you can start today. First, create an investment idea journal, just a notebook or a phone file. Next time you encounter a product or service that impresses you, write it down. Why do you like it? Is the store always busy? Do they have a unique advantage? This simple act of observation is the first step of Peter Lynch's method. You're not buying anything yet. You're just learning to see the world through an investor's eyes. You're turning over rocks. Second, practice the 6-month checkup. For any company you're interested in, or even one you already own a piece of, revisit its story every 6 months. Go to their website and read their latest quarterly report. Has the story changed? Are they still expanding? Is their debt going up or down? This builds the discipline of a long-term owner, not a short-term gambler. It forces you to ask, is this story still getting better, or is it time to move on? Ultimately, Peter Lynch's gift is that he demystifies finance and hands the power back to you. He shows you that you know more than you think, and with a little homework and a lot of patience, you have every tool you need to not just participate in the market, but to truly beat the street. That was a summary of Beating the Street by Peter Lynch. We've journeyed through the core of his wisdom today, but I'll be honest, a summary is like looking at a map of a beautiful country. It shows you the landmarks, but can't give you the feeling of walking the streets yourself. The real magic happens when you read the book. It's in the quiet moments when a particular story or simple phrase hits you unexpectedly. This summary is designed to help you decide if this book is worth your time. If anything we've talked about today has lit a spark in you, I encourage you to grab a copy. Reading it isn't just about learning. It's an experience that can genuinely change how you see your world and your potential within it. You can find a link to the book in the description below. Also, if you found this journey valuable, please take a moment to hit that subscribe button. It tells us we're on the right track and ensures you won't miss our next dive into another life-changing book from the billionaire's bookshelf. Thank you for joining me. Let's keep growing together.